Welcome to Age, Pension, Super and Retirement. I am your host Yvonne, and as always, this podcast is information only and not personal advice. Today, we will be looking at the Home Equity Access Scheme, and to help us unpack this, we will be welcoming back Rebecca.
Thanks, Yvonne. It's good to be here again.
It certainly is. Now, what exactly is this Home Equity Access Scheme?
So the Home Equity Access Scheme, it used to be known as the Pension Loans Scheme, but it's been expanded to not just people on a pension, but almost everybody over 67. So Home Equity Access Scheme, it's if you have a home or if you have real estate in Australia, you can use that as security and access the home equity that you have. Basically, it's a loan with the government where you put up your home as security or a portion of the value of your home, and the government pays you a regular fortnightly amount that you can use to top up your pension or instead of a pension. It's a type of reverse mortgage. Because it's loaned by the government, there's a bit more sort of protections and safeguards around it. So it's a loan. There is interest payable on the amount that you take, and it does need to be paid back. The loan needs to be paid back and the interest needs to be paid back eventually. Usually happens when the person dies or when they sell their home. It's an equity loan, so you're using the equity in your home to get some regular income instead of or on top of age pension.
That's so interesting, Rebecca. And you've mentioned that people need to be 67. So what actually do they need to do to qualify for this scheme?
So you have to be 67 and you have to apply through Centrelink for it. You have to own or be a co-owner of real estate in Australia. Now that might be the home that you live in. It might be maybe you have an investment property or a holiday house that you are prepared to use as security. So it doesn't have to be the home that you live in. It has to be real estate. Now, there's a technical or legal definition of real estate. People will probably think of like any house or any property is real estate. But there are some homes that are not technically real estate and they cannot be used as security for this loan. Like one example is a retirement village. If you live in a retirement village, that does not count as real estate and you cannot use that as security. If you live in a land lease community where you own the structure that you live in, you own the building, that your little unit, but you don't own any of the land, you lease the land. Yes, you own the building, but that does not technically count as real estate. So you won't be able to use that as security for this scheme. One thing in the ACT, all the land in the ACT is leased. You don't actually own it. But in the ACT, you can use your home. That still counts as real estate, even though you don't technically own the land. It's a lease. That does get around the rules. There's something different about how the ACT land rules work.
That's really helpful, Rebecca. Rebecca, how much can you borrow using this Home Equity Access Scheme?
Good question. Now, the amount you can borrow depends on your age and the amount you have to offer as security. So if your home is worth $500,000, you can decide whether to offer the whole value of the property as security, or you might be thinking, well, I want my kids to get something out of the property when I die. So maybe you'll say, I want to leave $200,000 worth of the property for my children. I'm happy to offer up to $300,000 of the value. So you have control over like how much security you're prepared to offer. Obviously, if you co-own the property with someone like a sibling or a child, you can only offer your own part of that property as the security. It's limited in that way. And then there's a limit with your age. So the older that you are, the government's thinking, well, if somebody is 90 years old, how long is it going to be their natural lifespan? and it's not going to be very long compared to somebody who's 70. So the government's kind of thinking, if we give this person $100,000 of loan payments, the interest on it is not going to accumulate to a huge amount, because from the time that they're 90 to the time they die is not going to be a huge amount of time. Whereas for somebody who is 70, their expected lifespan is a lot more. So there's an age factor that goes into it, but basically the amount that you can borrow is a factor of how much you're willing to offer as security based on how much your home is worth and your age.
That's really helpful, Rebecca. And I understand you don't need to be on the age pension, but could I ask, does it in some way interact or affect the age pension?
Yes. So the maximum amount of equity access you can get, there's a yearly limit and there's also a total limit. So the total limit is sort of what I addressed in the question before, but there's a yearly limit as well, and that is linked to the amount of age pension. So for a single person, the yearly amount of HEAS you can get is equivalent to 1.5 times the rate of single pension, less any pension that you actually get from the government. So let's say you've got somebody who's 70 and is self-funded. They don't get any age pension because their assets and income are too high. They could apply for the Home Equity Access Scheme and get 1.5 times the maximum rate of single age pension paid to them in that year as a loan. So their rate of the loan. Somebody else, so somebody who's 70 years old and is on full age pension because they have low assets, because they're already getting the full rate of age pension, the loan amount they can get is only half of the full age pension. So they would get their age pension plus half of the amount as a loan. So it's important to note that the loan that you get is tax-free. It doesn't count as income. So for the person who is on full age pension, the pension part they get is taxable and will go on their tax return if they need to lodge one. But the loan part, the extra, is not taxable and doesn't count as income. So they're not needing to pay tax on that extra amount they're getting. So it is linked to age pension. So for a couple, again, the maximum loan amount per year is 1.5 times the maximum age pension amount for a couple. And again, if somebody is on a part pension, say they get $500 a fortnight in actual age pension, the loan amount is 1.5 times the amount of age pension, less the $500 that they're getting as pension, and then the rest can be paid as a loan. Yeah, there's a bit of maths to go to work out. But what it means is that for anyone who's over 67, if you have real estate you can offer as security, you can have that income stream from the government instead of age pension if you're not qualified for age pension. And it means that you can be a bit more flexible about what assets you want to use to live on. For example, somebody might have their own home plus a holiday house, and they enjoy that lifestyle. They like having 2 homes and they don't want to sell the holiday home yet. The holiday home is being used towards their asset test. So maybe they get a very low amount of age pension, or maybe they get no age pension at all, but they don't want to sell it yet and they're not using it to generate income. So they don't really have enough income to live off. The HEAS is a way that they can get that income to be able to live the lifestyle they want to. And then at some point they might decide, I'm done with the holiday house. I'm happy to sell it now. They can sell the holiday house and pay back the government that loan. It makes it so much more flexible. And also, if you look on some of the commercial reverse mortgages available, the rates are probably a lot higher, and it's a lot more sort of predatory in terms of how the companies are trying to get control of your assets. After the time that you've used the money, you might not have much equity left in your home at all. So it's just a really helpful, flexible way of accessing some extra income.
That's really helpful, Rebecca. So would you say this is ideal for anyone who's short on cash that meets the criteria?
I guess it's something that anyone can consider. It is a loan, it needs to be paid back, so it's not free money. But yeah, depending on your situation, you might consider it. Like I said, if you've got a holiday house that you don't want to sell, maybe you've got a second home that a family member is living in and you're not ready to sell it yet because they need to live there and maybe they're not able to pay rent. So it's a way of getting extra income in that way. There's some people who are quite comfortable with debt. They might look at it as, well, my super is performing really well. I'd rather take this loan at the current interest rate is 3.95%. People might say, I'll take this loan and spend that money to live on. My investments are doing super well, and I'm happy to play that off against each other and, pay the interest while my investments are earning well. Some people are not comfortable with debt. Some people are like, I spent, 30 years paying off this house and I do not want anyone else to have any ownership of it. And that's fair enough. Maybe people don't want to offer their home as security, and that's like totally fine if you don't want to do that. People might also be thinking about estate planning. Maybe they want their children to be able to inherit their home, and using the HEAS scheme would reduce the amount of the home value that's passed on to your children. So there's lots of different things to consider. It's definitely not for everyone, but if there's a lifestyle that you're enjoying that you want to keep doing that you can't do if you only had the age pension to live on, it's certainly something worth considering. It'd be good to talk it through with a professional. So Centrelink themselves have a financial information service that you can make an appointment with and talk through the options you have. And you might also wish to discuss it with a financial advisor to look at your particular circumstances. It's definitely not for everyone, but for some people it can be a really helpful thing to do.
Super helpful, especially when you explain that if someone has lifestyle needs and they would like to use that money now rather than leave it for others to inherit. You touched on predatory reverse mortgages, and I'm sure that maybe people conflate the two. Would you be able to mention any other ways that the HEAS is different to a traditional reverse mortgage?
So one important way is that the Home and Equity Access Scheme, there's a limit to how much you can get per year. So as I mentioned before, it's 1.5 times the total age pension amount. And if you're on a full pension, it's only half of the amount again. So maybe you need to do major renovations on your home and you need a lump sum of, $200,000 or more. So the Home Equity Access Scheme is not going to be suitable in that situation because you just can't get that big lump sum of money out of it. Yeah, that's one reason why it's different to a reverse mortgage. A reverse mortgage provider, you could say, I need $200,000, and they'll say, sure, this is how we can do it. This is how much you'll pay back. They'll work it out for you. So there's limits in that regard. The HEAS interest is calculated on a fortnightly basis, which is most mortgage providers would do it on a monthly basis. So there's a slight difference there. Look, I don't know a lot about the different reverse mortgages available, but because it's a government scheme, I think it's a lot sort of safer. The amount that you borrow cannot exceed the value of your home. There's good calculations and safeguards in that to make sure that the person is not overextended, which means the government's likely to get all their money back. But yeah, it just helps in that way.
Fantastic, Rebecca. Would it matter if there was a mortgage on this property?
Yeah, that's a good question. So some people go, well, maybe I can't get the HEAS if I've already got a mortgage on my property. But no, you can actually still have a mortgage on your property. You would need to go to your lender and they would need to approve that there's going to be a second entity with a caveat on the property. So, if you owe the bank $200,000, you're going to say to the bank, oh, I'm going to go to Centrelink, and they're going to put a caveat on the property as well. So the bank has to give permission to do that, but it certainly can be done.
Perfect. And would you know what sort of interest rate is actually being charged?
So the current rate is 3.95% per annum, which is broken down to a daily rate, and then it's added fortnightly. That's the current rate. Since the loan scheme was started back in the 90s, the interest rate has changed over time. It's a rate set by the minister. And so when the minister decides that 3.95 is not a good amount, they can change it. It's not necessarily going to stay at 3.95% for the whole time that you have the loan. I was just going to look up the interest rate. So when the scheme started back in the 80s and 90s, the interest rate was 10%. In the late 90s through to 2000, the interest rate went down a little bit. So it was 7.9, then 6.25, 5.25. Yeah, it changes. So it was 5.25% for about 20 years from 1997 to 2019. And it dropped again in 2020. And then it's dropped again in 2022. So the current interest rate is 3.95%, but there is no guarantee that it's going to stay like that. The minister can change it.
That's really helpful. And for our listeners, that's October of 2025. Remember that this is always information only and never personal advice. Could I ask, Rebecca, what the payment frequency is, or could we actually get lump sums?
The payment frequency is generally fortnightly. So for people who are on a pension, it's just paid alongside your pension. When each fortnight when you get your pension, you get the extra amount paid with it. You can take a lump sum. The lump sum amount is the extra half of age pension. And you can get that once a year, basically. You can get like 6 months worth of age pension. So it's around $15,000 is sort of the maximum amount you can get as a lump sum for a single person. So, that might be helpful if maybe you've got a holiday that you're going to spend on, or maybe you need to replace a car and you take some from savings and some from the lump sum. When you take a lump sum, it's a lump sum in advance of those fortnightly amounts. Like, let's say your loan amount is $300 a fortnight. If you take a lump sum, they are going to not pay the $300 a fortnight for this next 6 months. So yes, you can get a lump sum, but it's a lump sum in advance, and it means that you won't get that amount in your fortnightly payments for the next little while. So yes, you can, but it's not a huge lump sum. It's not a massive amount that you're going to be able to use to do major renovations or big purchases. So yeah, it needs to be worked out how it's going to work for you.
That's really helpful, Rebecca. And you mentioned a loan. What would the maximum be that someone could borrow with the HEAS?
Quite large amounts, really. So I'll just quickly look up the guide where there is an example. Now, the examples in the guide are quite outdated because they sort of give property values of, 240,000, which is, very low in today's market. So it gives an example of a 70-year-old person who has a property, who offers $100,000 of security. Their maximum loan amount is $30,000. But that's kind of not really helpful because we've got property values are much higher nowadays. But let's say somebody had, I'll work it out now. So for somebody who's 70 years old and has a property that's worth more than $1 million, and they are prepared to offer $1 million of equity in that property, using the conversion factors based on age, that person would be able to get a maximum loan amount of $308,000. So that's not going to be paid all at once, as I said. There's a maximum amount per year based on the single age pension rate for a single person, but it can go up to that amount of $308,000. But there's a caveat in there because as the person gets older, that maximum loan amount is actually recalculated every 12 months. And because the person is getting older, the maximum loan amount actually increases over time until it reaches that $1 million that the person originally offered as security. So it's quite a large amount. So, $300,000 is a lot of money that the government can give you as a loan. you may not want to take that much. You might want to take less. That's fine. You might not want to offer so much as security. Again, that's fine. And then over time, like if you get this loan out when you're 70, at 80, your property is going to be worth more, we hope. So you can, again, recalculate the loan amount then and say, my property's worth more. I can therefore offer more as security, and Centrelink can recalculate the loan. One thing I haven't mentioned yet is that there is an application fee for this HEAS scheme. There are fees associated with it. So when you go to the bank, if you've got a mortgage and you go to the bank to put a caveat on your home, there will be a fee to do that. And there's also a fee when the government puts a lien on your house. So there's a fee for that, and that's payable by you. And it's usually a few $100s. So it's not a simple free thing. There are fees associated with it, but you wouldn't just not do it just because there is a fee. If it's the right decision for you, you can pay that fee and get the loan.
Fantastic, Rebecca, and thanks so much for doing the maths. That's amazing. Just to clarify, you mentioned this loan can be paid back at death if the house is or home is sold, and I assume if the person has a windfall. That's how I understand it. Are they the options?
Yeah, so you can repay the loan at any time, make a voluntary repayment in full to close the loan. And yeah, they might be if maybe you've decided to sell that holiday home, or maybe you've received an inheritance. So you can do that. I know of one person in our group who has one of these loans, and for them, they pay the interest every fortnight when it comes. So the loan amount is growing each time, but just for them, they just feel better about it having no interest. So they pay the interest component each fortnight. And in terms of Centrelink, they'll just see that as a voluntary repayment, a small voluntary repayment each fortnight. So you can do it that way. That's one way that for them, they don't want the thought of the interest building up. So they pay the interest each time, and that just works for them. So yes, you can make voluntary repayments. You can also pay it when the property that is held as security is sold. The loan should be repaid. But in some circumstances, the person might be purchasing another home, and the loan can be transferred to the new property if the new property, meets the requirements. So you would need to talk to Centrelink about that and tell them, I want to transfer the security to the new property, and they can arrange that. Or yes, when the person dies. So we'll assume it's a single person. When the person dies, Centrelink will calculate how much the total is that needs to be repaid, and it is a lien on the property, so it has to be paid out to Centrelink before the remainder of the value can be paid to family members in the will.
So helpful, Rebecca. I'm curious, what is the phrase no negative equity guarantee all about?
So that's one of the safeguards in the system, that the amount that's repaid to Centrelink cannot exceed the value of the property. So, and the guide gives an example of, where somebody they have a home, they have a mortgage on the home, and they've got a loan from Centrelink under the Home Equity Access Scheme. And it's all worked out when the person's alive and they start getting the loan payments. And then when the person dies, they've still got this mortgage of $200,000. They've got a $300,000 loan amount from the HEAS, and the property has gone down in value, and the property at death is only worth $450,000. So you've got $500,000 owed against the property, and it's only worth $450,000. And what Centrelink does is that the mortgage, that the bank is going to recover the $200,000 from the mortgage, and basically Centrelink just wipes off the remaining part of their amount that they're not going to get. So they're going to get $250,000 because that's all that's left of the equity of the property, and the $50,000 extra is just white. The family doesn't have to come up with that money. It was tied to the house. The house has no more equity to use. So, yeah, that's what it means. No negative equity guarantee. So your family members are not going to be saddled with that extra that you have, if your property's gone down in value or something like that. There are some exceptions. If you're doing dodgy things and misrepresenting your property or yourself to Centrelink when you start the loan, if you're being dodgy and telling fibs about what the property's worth and all of that, then they are going to try and get that money out of your estate. But let's assume you're doing all the right things and you've been honest about your situation. If there is negative equity, it just gets wiped.
So interesting, Rebecca. Can I ask, are there any online calculators for the Home Equity Access Scheme?
Not that I've seen. There is in the guides to social policy law, the Social Security Guide, there is the formula that's there. So you can kind of work it out, how much equity you have available and what your maximum loan could be. There might be calculators out there. I haven't seen one. But a good way to do it would be to make an appointment with the Financial Information Service at Centrelink. If you go to them with details of the property that you're going to offer as security and any loans you have against that, like maybe you have a mortgage, and an idea of any amount you want to keep for yourself or for family members when you pass, and they can talk to you about what amounts you might be able to get.
This has been so interesting, Rebecca. As I've been listening, I think a lot of people don't know about this, and there are some people that may not have much in the way of superannuation and are just stuck for how to do some home repairs or if they'd like to go on a holiday. I think it is something that a lot of people may benefit from.
I agree. And probably people don't know about it until it's almost too late to get much benefit from it. So I think, especially if you're wanting to do major purchases or major renovations, it's probably helpful to start this loan before you run out of other money. So not just when you've got nothing else left, no super, no bank savings, but to do it when you do have some other funds available as an emergency fund or whatever, and to start this HEAS thing sooner rather than later, so you can actually get an amount from it that is helpful to you.
Such amazing information. Now, as always, this is information only and never personal advice. For our international listeners wishing to join our Facebook group, the code word is orange. And thank you so much, Rebecca. This has been really interesting.
You're welcome. I hope it's been informative. There's lots more information on the website to read over. And again, make an appointment with the team at Centrelink and they can help talk you through it some more.
Thank you.
You're welcome.